So, on today's show, we have Jason Hartman, who is the founder and CEO of Hartman Media company, Jason Hartman Foundation. Starting with very little, Jason, while still in college at the age of 19, embarked on a career of real estate while brokering properties for clients. He was also investing in his own portfolio along the way. Through creativity, persistence, and good old fashioned hard work, he soon joined the ranks of the top 1 percentiles of realtors in the US, and in quick succession earned a number of prestigious industry awards, becoming a young multimillionaire. Jason purchased an Irvine, California real estate brokerage firm, which he expanded dramatically and was later acquired by Coldwell Banker. He combined his dedication and business talents to become a successful entrepreneur, public speaker, author, and media personality. The Creating Wealth podcast, for which I'm a big fan, inspires and empowers hundreds of thousands of people in 164 countries, while he also gives back with his foundation. And today, his belief system is centered around us being in a global monetary crisis caused by decades of misguided policies. And the cycle of financial dependence has broken literacy, and self-reliance is a good start to help alleviate that and remediate that problem, if you will. So, Jason, thank you for doing us the pleasure of joining us today.
Ross, it's my pleasure. Good to be here. And I'm glad you reached out to me back when I was in Ireland, maybe 6, 7 years ago, and we got together for lunch. That was fun.
Do you know what? It is 6 years ago. I was just looking back, and it was June of 2015, if I'm not
Yeah.
mistaken. So you had said on your show, I'm going to go visit Europe. I'll be stopping off in Ireland and Croatia. I was like, well, that's where I am. So
Yeah.
let's see if we can meet up. And you did graciously. We had a great chat. And
Yeah.
yeah, you kind of learned about where we were at that time. We were doing a referendum, and which we're very big fans of. Our constitution is pretty important to us, and changing it requires that. So that was an interesting dynamic. But the reason I wanted to have you on today's show really was to understand your philosophies about the new economy we're in. So I help tech companies find world-class talent. I think tech are an entire economy in and of themselves. And I'm keen to understand, from an economy, from an economic perspective, like where have we been, where are we going to, and what's this new world we're living in after COVID? They're separate issues. Let's take them one by one, but maybe just share with us, what you're seeing out there as an expert in this space, and why we're in a scary place right now, quite frankly.
Yeah, so there are quite a few trends going on. One is the mass migration out of high density cities to more suburban and rural markets. People are moving. Finally, it's long overdue. The virtual technology caught on, and everybody's pretty much accepted it now. It's not new technology; it's been here for 20 years, right?
Mm,
But finally, people adopted it because they had to, and so that's a great trend, I believe. People are improving their standard of living. They're getting less expensive houses. They're getting more house. They're getting just a better standard of living, moving out of big cities. So that's one trend. Another is we see governments all over the world and central banks all over the world uh, creating fake money out of thin air at the fastest rate ever in history. It's
mm,
absolutely shocking how currencies around the world are being debased.
mhm,
That will create, well, it already has created, but will continue to create inflationary pressure. And everybody listening and watching needs to be aware of how to defend themselves against the specter of very serious inflation, because inflation is basically a thief that steals our purchasing power. It degrades the value of our savings accounts, our stocks, our bonds, even our equity in real estate, and we need to defend ourselves against inflation. And the powers that be, Ross, they want inflation. Inflation is actually
mhm.
quite a good deal for governments and central banks. It's their business plan, and we can complain about it as much as we want, but none of us are going to change it. These are the most powerful forces the human race has ever known, and they will create inflation uh, no matter what. There may be deflationary spats in the mix in the years to come, but overall, I believe the trend is inflation, and I believe it will be very significant.
So, Jason, just for our listeners, and for those who aren't in the know around inflation, from a U.S. perspective, this was a U.S.-led trend that happened when Richard Nixon in the 1970s
Yeah.
took the U.S. off of the gold standard. The central bank, or the Fed in the US, was created, obviously, and we know, in the 20s.
1913, actually. Yep.
13, I
Before
beg your
that.
pardon,
Yeah.
before the 20s, in fact, yeah.
Yeah.
Which was a conspiracy of some central bankers, or some
Oh, yeah.
bankers at the time, and some industry captains and so on. But for those of our listeners who don't know that, what was the gold standard, and why is money printing so dangerous today?
Yeah. Well, let me share some visuals for the people who are able to watch this. If they're only listening, I'll try to just sort of explain them so they don't need to see them. But if they are seeing them, all the better. And I'll just go through that a little bit. So on my Creating Wealth podcast, as you know, Ross, because you're a
Mhm.
listener, I talk about this stuff all the time. And one of the biggest questions I'm asked nowadays is, "Are we in a bubble?" Actually, it's not nowadays. It's that question's been going on for easily 5, 6 years, actually, probably since we met. And since people started asking that question coming out of the Great Recession, the prices have just continued to increase and increase and increase. And what I'm talking about is housing prices. So, to answer that question, we need to simply compare. And the real estate market in most places around the world, not just in the US, is like this. This is a funny meme, right? It's a couple looking at a house, and they say to the realtor, "We'd like to look at something a little higher priced." And the realtor says, "Okay, I can show you this house again tomorrow."
Love it.
Because it'll be higher priced tomorrow. And that is the sign of a bubble, right? When things are that crazy, one would think we better be careful, right? We better be careful. But with the inflationary powers, maybe we're not in a bubble. And I'm going to give you some reasons that maybe the bubble is not here yet in real estate prices. And this stuff applies in the US. It also applies around the world because it answers really, I believe, life's most important question. And I'll get to that in a moment.
Great.
But first, let me talk a little bit about, because you mentioned central banks and the Federal Reserve 100 years ago, over 100 years ago, the most powerful central bank in the world is the US central bank. And we are in a situation where we have, and when I say we, I mean the U.S. and really every country on earth has a serious, serious debt problem. Politicians love to spend more money than the government brings in, because that's how they get votes, that's how they stay in power. And so there are 6 ways I've identified that the US government, as well as others, can get out of the mess they're in, the debt mess they're in. Number 1, they can simply default on the promises they've made. They can say to people, "Look, sorry, we don't have enough money to pay for welfare programs, social programs, even police, fire, whatever," right? Whatever governments do, whether they be federal governments, state governments, local governments, they're all in trouble, pretty much. This is pretty much a worldwide problem, okay? Massive debt problem. Very unlikely that a default would happen, because it's very harsh. We all saw what happened in Greece when the austerity measures were instituted. We've seen the yellow coats in various countries in Europe, and we've seen these austerity programs just do not go over well. Riots in the streets. Raise taxes. Well, that in the U.S., the problem cannot be solved by raising taxes. It's simply too big. The math doesn't work. There's not enough taxes to get to solve the problem. In the U.S.'s example, and Greece was actually thinking of this when they, had the first part of their crisis, selling off assets that they have. Greece was going to sell off islands to people to raise money, right? The US years ago was going to sell the ports to Dubai. It didn't happen, but the US sells military equipment to all sorts of countries it shouldn't be selling it to. And it's just doing that to, help solve the budget problems. Steel. This is the history of the world. It's nothing new. Militaries have been used to steal the resources of other countries for as long as humans have been around and militaries have been around. Napoleon was famous for it. Before he would go and wage war, he would think about, look at all the riches they have. Let's go take them. It's basically armed robbery, okay?
Sure.
But with the military instead of the typical thing we know as armed robbery. On the good side, technological innovation, right?
Yes.
This couldn't create prosperity for humanity and it's good, and it happens incrementally. Maybe there will be a major innovation, and that will really change everything. But the most likely plan, and the plan that's already been followed for a long time, and I believe will continue to be followed for a very long time into the future, is to simply inflate the way out of the problem. And what I mean by that is this: look, at the US owes a lot of money to China, for example.
Hmm.
And if you have $1 trillion that is owed, and the inflation rate of the US dollar is 10%, and that could be over 1 year or 3 years, doesn't matter, but say 10% inflation occurs. Well, that means your debt basically declined by $100 billion because you pay the debt back in cheaper dollars
Sure.
as the currency is devalued. Yes, it's called the same thing. The name of the debt didn't change, but the real value of it changed quite a bit.
In terms of purchasing power, right? And what that
Right.
actual dollar will buy me when it's
Right.
inflated later down the
Yeah.
track. It's
So when the
90% what it
Chinese try
was.
to spend that US dollar back into the US economy or worldwide, because it is
Mm,
the world's reserve currency, it's less valuable against a whole set of real value commodities. So look at these. One of my listeners actually in Ireland
no
years ago
way.
sent me these. Okay. And these are Zimbabwe dollars.
Sure.
And, here you have a $100 trillion Zimbabwe note, right? It's pretty much worthless. Okay. So it's the name of it doesn't change, but the value of it changes. Okay. So to understand monetary policy and to get excited about how we can make this work for us, we have to understand a few things that are very important. Number one, inflation. Okay. Uh, we need to distinguish between real and nominal, like I said about the US dollar, the Zimbabwe dollar, the
Sure.
peso, the real, the yen. Doesn't matter what the currency unit is, it's the same thing. Nominal is the name of it, real is the value of it, what it will actually buy for you, the
Got it.
purchasing power. Inflation is the insidious hidden tax that destroys purchasing power. It destroys the value of stocks, bonds, savings, equity in real estate, even. And thankfully, my favorite four-letter word, debt.
Mhm.
Inflation destroys the value of debt. And I'll show you an example of that in a moment. It's the most powerful way to redistribute wealth, and it redistributes wealth from lenders who get paid back in those cheaper dollars over time to borrowers that get to pay the loan back in cheaper dollars over time. Or, and when I say dollars, substitute whatever currency unit you want, could be the euro, doesn't matter.
Sure.
Okay. It's just
Great
a
point.
currency unit. And it also transfers wealth from old people to young people. Why is this? Well, because old people generally, or at least hopefully, have savings and they have stocks and bonds, and the inflation devalues them or debases them. And young people generally owe money, they have
Yeah.
debt, and
Sure.
inflation debases that. So the young people benefit without even having an inheritance. Okay. So housing prices are absolutely crazy right now. That's what most people think, Ross.
Yes.
But the reason they think that is because they're only thinking of the prices compared to one thing: dollars
Yeah.
or euros
Sure.
or pesos or
Mhm.
whatever, right? They're not comparing them to things that have intrinsic value, which are commodities that the entire human race needs. That's what you should be comparing to, not currency units. So in
What does that mean,
dollars,
Jason, in
yeah,
terms of value? And I'm keen to get into this because house prices here in the Republic of Ireland are absolutely stellar at the moment. They're going up 50 and 70K when a house price, when a house sale falls through, they're relisting them at the actual sale agreed price from the prior listing and just going again on a second run. I mean, you have 20% above asking right now happening. Um, so I'm curious to know, what did you mean by the price is actually not compared against the right metrics? And secondly, what does that mean for where we are today in a technically enabled world where you can work from anywhere? Why are people not doing that more? And how are companies going to have to adapt to that? So take us through those points if you
yeah.
would.
Well, people are doing that more. Lots more people are working remote than ever, and I think that's just a great trend. As long as they're productive, I think it's
Sure.
fantastic. Mostly people like it. There is certainly resistance against it from companies and from individuals. So, I think we're moving into a world where we're really going to have a nice hybrid
Mm.
system, and that will decrease pollution. And it's just better for the environment if people aren't driving, and so I think it's a very good trend. And it's what there are many benefits that have actually come out of the pandemic, and that's one of them.
So one of the trends I'm seeing is as people move more towards working remote, companies are trying to sell that as a fantastic benefit that we don't have an office, etc. And that's great, and that has a lot of potential. And that does come with challenges, and I'll explain why now. So Ireland, as you know, and I took you on a bit of a tour of the city, and I appeared on your podcast explaining about how the tech multinationals have very cleverly avoided paying corporation taxes. And one of the deals that you have to do with that is that you employ people here in the country, that you are giving back, that you have a significant critical mass of employees who are, i.e., paying payroll taxes and giving back to society. And our deal with the universe was if people have jobs, that's generally a good thing. And we create the tax revenue there, and the companies are funding that, and everyone kind of wins. The challenge you have is that we had a lot of French, German, Spanish, Italians, British multinationals coming here because of that employment. And now they're not coming here because they can potentially work from their home country, and companies are having to adapt to that. And also, you have maybe
Well,
multiple tax returns to do.
that just means these tax regimes are outdated, and they need to
Why the
catch up
government
with
never
reality.
keep up, and where do you see government trying to play catch up going forward?
Well,
Because I see,
look at government around the world, anywhere is always the last player, right? They're governments are bureaucratic, and so they don't get it. It takes them a long time to come around, but they will eventually, and all these tax regimes are basically the result of, I mean, in the U.S., lobbyists and
sure,
corruption,
sure.
and self-interest. But in other countries, they have other systems, and but it's basically a result of lobbying.
And when you say, so for me, the question would be, where's the tax going to come from? So you talked a little bit earlier about how there are 6 ways to get out of this mess, and tax increases is potentially one of them, but you don't see it flying. Why can you not increase taxes, number one, mathematically? And number two, where are they going to redistribute the tax collection points? And what does that look like going forward? Because you're going to have property taxes in different spaces. Like the Northeast is crazy, for example, in the US. You're going to have commercial rates going to be redistributed,
Yeah.
etc. What does that look like?
Well, that's anybody's guess. But it may be based more on the VAT type system, like a
Hmm.
lot of European countries have. In the U.S., we may move to something like that. Maybe based more on consumption or sales tax. Who knows? I mean, this is just nobody knows what will happen with this stuff. But the point is that we live in a world of knowledge workers mostly. Well, maybe not mostly, but at least those are the highly paid workers, are the knowledge workers, and they're portable. You can have knowledge and express knowledge from anywhere you have an internet connection. So governments have not caught up to that yet,
Yeah.
and people can vote with their feet much more easily than they ever have been able to in the past. So we'll see what happens. But the point is, inflation is a
Hmm.
real threat. Okay, it's a real threat. So let me take you into some of these comparisons that you asked about, because I think those will be really valuable to people.
Great.
Ross, as you know, I teach something called inflation induced debt destruction. And this is a technique that especially real estate investors can use to create wealth through inflation. Not because of what people think, oh, real estate's a good hedge against inflation. That's true, but it's amateur. There's a much better way, and we don't have time to go into it today,
Okay.
but just know that it's there. You can get more details on my YouTube channel or my podcast, The Creating Wealth Show, and there's a lot to it. You know about it, of course,
Absolutely.
but for your listeners, I just want to mention that to them. But what we need to realize is are we measuring one price of one item against the right thing? Most people just default to the lazy way of doing it, which is measuring it against currency, dollars, euros, yen,
Hmm.
whatever, right? But I say that is faulty and will lead to very bad decision making. We've got to measure we've got to measure things against uh, commodities that the entire world consumes. Now, understand one disclaimer here. We really have three types of markets around the world: linear markets that are the slow and steady markets, and I believe they're the most profitable markets.
Right.
They are boring. They don't make a lot of headlines. They're not Dublin, Paris, New
Sure.
York, London, Dubai, Hong Kong. These are places like Little Rock, Arkansas, Memphis, Tennessee, Ocala, Florida, okay, Jacksonville, Florida. These are places that they're not trophy places, okay, but they are places with fantastic cash flow, good rental property investments, and that's what I show on my website,
Embrace the
jasonhartman.com. Yeah.
fragmentation, as you always say.
Yeah, embrace the fragmentation, definitely. The cyclical markets are the markets that get all the attention. They're the trophy cities I just mentioned. Hybrid markets are in between the two. So these three types of markets do act very differently, okay? But the question we always have to ask is, compared to what? I
Mm.
believe this is life's most important question: compared to what? So, a derivative of that question is it cheap or is it expensive? When it comes to housing prices, is it cheap or is it expensive? Well, let's take a look at that. I created an index called the Hartman Comparison Index, the HCI, to help people understand if housing is cheap or expensive. So let's take a look at just one part of it. Ross, I talk a lot about something I call packaged commodities
Yes.
investing. And I won't go into that now, but it's part of the index just naturally. Okay. So let's compare housing prices to gold prices. You mentioned our former president, Richard Nixon,
Yes.
who in 1971 detached the US dollar from the gold standard. This was a hugely significant act. He said it would be temporary, and now it's 50 years later next month. It isn't temporary. Okay.
Sure.
And that allowed for rampant government spending and inflation to occur. And so let's just look at history and see what that did
Mm.
vis-a-vis uh, what the entire human race pretty much considers money for the last 5,000 years,
Let's
and that
go.
is gold. Now, I'm not a gold bug. I want to just make that clear, but
Hmm.
gold is a measuring stick. So let's just look at that real quickly. In 1970, in the US, the median price house was $22,600. Gold was $35 an ounce. So if you wanted to buy the median price house in 1970, 51 years ago, it would cost you 646 ounces of gold. You'd have to have a pretty big suitcase for that. 646 ounces of gold. And by 2000, and I'll just skip ahead a little bit because we don't have time to go decade by decade, but if you're watching this, you see it on the screen. By the year 2000, 30 years later, the median house price is 173, I'll just round off, $173,000. Gold is 283 per ounce, and it'll cost you 610 ounces of gold to buy the median price house 21
Interesting.
years ago and 30 years later than we started. So, priced in gold in 30 years from 1970 to 2000, the house actually got a little cheaper. You saved 36 ounces of gold. But
Interesting.
priced in dollars, the house got $150,000 more expensive.
Interesting.
So if over, say you were saving money for 30 years to buy a house, right? Some people do that. Hopefully it doesn't take that long. But say you were, just as an example. If you saved your money in dollars, that house would have cost you a lot more money. Okay? And I'm using money not as currency. There is a
Right. And
difference.
there's a big
Okay?
difference. Yeah.
Yeah. So, but if you saved your money in gold, the house would have actually gotten cheaper in 3 decades. Now let's take it to today. By June of this year, the median house price was $348,000. Gold was $1,787 per ounce.
Wow.
So if you wanted to buy the median price house in dollars, it would cost you $347,000, a lot more than ever before. That's a record. in
Sure.
dollars. But why would you just compare the price of the house to dollars? You would make foolish decisions doing that. If you compare it to gold, the house got cheaper, only 194 ounces of gold to buy a house in 2021.
Wow.
51 years later, 51 years after 1971, the house is more than two-thirds cheaper priced in gold than in dollars.
Incredible.
So the question is, priced in gold, are houses cheap or expensive? They're cheap, 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 cheap. Okay. Very cheap, actually. So when the question is asked or the concern is raised, are we in a bubble? We have to say, compared to what?
Yeah. And in which market, right?
And which market, certainly, but compared to what overall? So let's do one more thing and we'll wrap it up. Let's compare housing prices to something else. Not Bitcoin. It's very cheap in Bitcoin. Okay. I want to compare it to the world's most important commodity, oil.
Mm-hmm.
Oil is the most important commodity in the world, if you ask me. Forget about what the tree huggers tell you. The fact is, the world still runs on oil. Oil is the most important commodity, I would argue, in the entire world. Now,
Mm-hmm.
maybe you could argue with that and say after food and water. Okay, fine. That's probably true. Okay, but practically speaking, oil runs the world. Okay, so let's go back to 1970 and let's figure out how much oil would you have to trade for a house. Okay, so in 1970, that median price house, $22,600. Oil only $3 a barrel. I mean,
Wow.
$3 a
Mind
barrel for
blowing.
oil. Yeah, cheap, very cheap. So in 1970, it would cost you 6,746 barrels of oil to buy a house. In
Crazy.
2021, that house is $347,000,
Mm-hmm.
347.5. Oil is $75 a barrel. It would only cost you 4,622 barrels of oil to buy the median priced house. So priced in oil, are houses cheap or expensive? They're cheap. Isn't that interesting?
It's fantastically interesting. And, if anyone was in ever any doubt whatsoever as to the direction we're going in and how inflation is picking your pocket every day of the week, there is no clearer comparison than that. That's fantastic.
Yeah.
I suppose.
And just so you know, the HCI, the Hartman Comparison Index, indexes over 40 commodities and services to make the comparison.
Okay.
And overall, the comparison on a housing price basis, housing is still historically cheap. But most people will miss that because they only price it in their own currency. And that is a giant, giant mistake. Now, there's one more element, Ross, that's very important. And we don't have time to take a deep dive into it today. But because the interest rates are so artificially low, when you price not the house, not the price of the house, but the way most people buy a house, which is based on the monthly payment,
Right.
the houses are incredibly cheap. They're much cheaper than pricing the Hartman Comparison Index compared to the price of the house. When you price the Hartman Comparison Index to the payment on the house, houses are just dirt cheap. It's absolutely amazing.
So I guess my question would be, as we kind of round the corner here, as we look into the future and we look at central banks continuing to print money, and we look at governments selling off gold reserves, quite frankly, because my attitude, and you saw this in the UK, I think the US have sold off some of their gold reserves, and there's a whole conspiracy around, is Fort Knox empty? Who knows? But that's a whole other day's conversation. Why are they doing that? Because my belief is that central banks are here to stay, printing money all day long like there's no tomorrow, and that's going to be the continued strategy. Where do we go when we can't get interest rates any lower?
Well, this is the situation when the low interest rates like this are not good. They are toxic. You look at, as real estate investors, I love these cheap interest rates. That's
Sure.
the best deal ever. You're literally getting paid to borrow money. It's absolutely amazing. And if you want to learn more about that, go to my YouTube channel, go to jasonhartman.com, type in inflation induced debt destruction. I know it's a mouthful, but I will teach you about that. Okay. And I don't know that the central banks on the whole are selling off gold. I mean, I read articles that central banks are buying gold. Okay. So, I mean, it's moving around, right? It is traded. So some are selling, some are buying, right? And, maybe they just need money. Okay. So they're selling off assets to raise money. But to answer your question about the low interest rates, it's tough because you could look at it like this: if you've got a gun, a revolver that's a six shooter, right?
Hmm.
Um, the Federal Reserve, the U.S. government, other governments and central banks around the world, by instituting these low interest rate policies, they've basically shot five of their bullets. They've only got maybe one bullet left. And if we enter into another crisis, we've used most of the bullets.
Right. I couldn't
Okay,
agree
there
more.
there isn't there aren't a lot of tools left for them. They can do quantitative easing, they can do low interest rates, which are part and parcel of the same concept of easy money policy. But they use up a lot of their tools, and that's why they must raise interest rates as soon as possible to reload, so that when the next crisis comes
Yeah.
along, they can then ease. And look, I'm not in favor of central banks. I don't like them.
Mhm.
A centrally planned economy is not good. The economy should simply be a free market. The value of currency should float based on what the marketplace thinks it's worth, not what a government tries to tell you it's worth, or a central bank, either one. So that's the danger we're in.
Very, very wise words indeed. So I really want to thank you, Jason, for doing us the honor of being our guest today. I would welcome you back on future shows so we could do those deep dives if you're open to it. And I want to thank you again.
Ross, my pleasure. I just want to wish you and your listeners happy investing. I hope the information was helpful. And of course, you can find out more on my podcast or YouTube channel or jasonhartman.com. So thanks again.
My absolute pleasure.